Okay, so good afternoon, everybody. Thank you very much for joining this webinar on the 2627 Accounting Code of Practice. My name, for those of you who don't know me, is Conrad Hall. I'm the chair of the CIPFA Code Board and also the Corporate Director of Resources and Section 151 Officer for London Borough of Newham. You see up on the slide there my colleagues from the CIPFA Secretariat who will be running through the material that we have for you this afternoon. So Ben Matthews, Technical Advisor at CIPFA, Hazel Watton, the Public Sector Financial Reporting Manager, and David Lyford-Tilley, who's the Head of Technical and Standards at CIPFA. And in a moment, I will hand over to them. Just a couple of points on etiquette. Obviously, we don't need the old-fashioned messages about keeping phones off or whatever, and I think that the tech will just mute colleagues in any event. The session is being recorded for the benefit of making it available subsequently, so just to be aware that by participating, you agree to that. There's a Q&A function. I'm sure everyone's familiar with those. So any questions that you want raised, if you put them in the Q&A, I will make sure that we deal with those in the hour we've got. We've got about probably 20-25 minutes of material, so plenty of time for questions and answers. So do think as you listen to our speakers about issues you want to raise, or indeed if you've got issues already, the sooner you get them in the Q&A, the easier it is for me to manage the second half of the webinar that way. With that, I think I will pause and I hand over, I think in the first instance, to you, isn't it, Ben?
Yes, thank you, Conrad. Right, so I will get us started with the first slide. So in this update, we're going to cover developments that will be incorporated in the 2627 code or beyond. So we're going to look at CIPFA strategic plan and longer term reforms, changes to standards, other financial reports on emerging issues, and then, as Conrad just mentioned, we'll also have some time for any questions at the end. Just get the next slide. Right, so introduction to longer term reforms. So CIPFA is continuing to advance longer term reforms in line with its strategic plan, and they've been gaining momentum with longer term financial reporting reforms alongside CIPFA through the Better Reporting Group. The 2627 Code ITC is an opportunity to share this early thinking on financial reporting reforms, to gather your views, so to gather all of stakeholder views, and then to better understand any potential areas of concern. So it is really important that we do get to hear from you and hear from your views. So this is just a plea at the very start. Please respond to the consultation. Even if you've only got specific items that you'd really like to respond to us on, and you're actually quite happy and that the others don't affect you, then just send us a response to that effect. So we don't need you to respond in detail to every single question. So please just respond to the consultation with your views. So as part of reforms to local authority financial reporting, in this consultation, we're also seeking views on whether to remove the expenditure and funding analysis, the EFA, and we're also seeking views on overhauling the structure and format of the code. So we really see this as a first instalment of accounting reform, with further changes to come in the 2728 code and beyond, which are building on outputs from the work of the Better Reporting Group. So as we were just saying, CIPFA has continued to progress its strategic plan, with the main focus being on improving the presentation of financial statements and ensuring that accounts clearly communicate their key messages to users. And it is worthwhile noting that though the primary objective remains clarity for users, it is also hoped that any resulting changes will ease some of the resource pressures faced by local authority accounts preparers and auditors. And therefore, with this in mind, the two main pillars being focused on at the moment are better reporting and the review of the structure and format of the code. So we'll move on to the next slides, which will be providing you with a bit more detail and a bit more information on these. So we've already covered the fact that longer term reforms are the priority. And now this is the opportunity to look at a little bit more about what this means in detail. So for longer term reforms, the Better Reporting Group has been relaunched as the primary vehicle for generating innovative improvement ideas. So the group have been given flexibility to explore new ideas and the ability to propose changes to standards and guidance. And projects being progressed in 2025 are highlighted in orange on this slide. So these were chosen based on where it was felt there could be the most significant impact following stakeholder feedback. So these projects, they've been making good progress this year, and we're expecting thought leadership position statements on projects such as users of the accounts and materiality. We're then expecting guidance on indexation for non-investment assets. This guidance has been tailored to local authority circumstances using the Treasury's FREM guidance as the basis. And these are expected very soon, so within the next couple of months. Then we're also hoping for reforms coming out of the statutory overrides and LGPS pensions reporting project. So these will be consulted on in a future co-consultation. So they could include potentially changes to standards, but we'll have to wait and see. So hopefully this gives you more of an idea of what is going on behind the scenes. And throughout the BRG's programme of work, and there already has been, there'll be calls for volunteers to contribute their specific expertise and ideas as projects emerge. So we actually have a dedicated page on the CIPFA website, so please do visit, take a look, have a look around and let us know via the online form if you're interested in volunteering too. So next up, I also mentioned another project, and that was the format and structure of the code. So there are two proposals in the code ITC, and just want you to note that the proposals relate specifically to the code rather than the accompanying guidance. Now, proposal 1, this responds to concerns that the code is becoming increasingly unwieldy. So it's looking at a complete overhaul, really fundamental changes, and this would involve removing all duplicated IFRS material and require users to refer directly to the underlying accounting standards, so via the IFRS website. And one of the main benefits, we believe, is that this would allow adaptations and interpretations to be seen more clearly. So where we adapt and interpret IFRS for the local authority context, we believe by referring directly to the IFRS and then just showing where we have the adaptations and interpretations, it makes it a bit easier to see where you do have those adaptations and interpretations. So we think that would provide more clarity and highlight those divergences between the code and the accounting standards, which is also similar to the FRAM. And it also eliminates the risk of misrepresenting the intent or substance of IFRS through paraphrasing or when requirements are selectively copied over. So at the moment, with IFRS, sometimes we'll copy certain bits, sometimes we won't, but even the bits that we don't will still apply unless they've been adapted or interpreted differently. So by just referring directly to the standards and having those adaptations and interpretations clearly set out, we think that would make things a little bit easier to understand. And while it might initially be seen as an inconvenience, it is always best for practitioners to see and use the true underlying source, and it is more likely to lead to high quality implementation of IFRS. With that being said, though, there is also a second proposal. So equally valid proposal. Proposal 2 will be to continue to resemble the 25-26 code format, and that incorporates the wording directly from the underlying standards as we just spoke about. So proposal 2, as we mentioned, it's still reasonable, and we know from previous consultations that some practitioners do prefer having all the information within one document. So proposal 2 continues to bring together specific requirements for the specific elements of the accounts, and it will still clearly highlight the interpretations and adaptations to IFRS as well. So still a valid option, proposal 2. Next up, we're going to just look at something that I'm sure will generate quite a lot of discussion in the ITC as well. Another item, which is the expenditure and funding analysis. So we're seeking views, the ITC is seeking views on removing the expenditure and funded analysis in its current format. So the EFA was brought in to provide a direct reconciliation between the way local authorities are funded and budgeted for and the CIS in a way that is accessible to the lay reader. And it was intended to promote accountability and stewardship. And although the scope of IFRS 8 is for entities whose debt or equity instruments are traded in the public market, it contains useful principles that the EFA sought to adopt. However, there has been anecdotal evidence that suggests it may not be fully achieving its intended objectives, and some respondents in the 25-26 code felt that removal would ease some of the burden on preparers and auditors. So what we're doing in this ITC, in the 26-27 ITC, is we're asking if the EFA should be removed and if it should be replaced with an alternative statement if it is removed. So the ITC does also ask if you would support removal for the 26-27 financial year, even if it is not immediately replaced with an alternative statement, and whether you foresee any issues regarding compliance with IFRS if the EFA was to be removed. So just again, if you have any ideas or suggestions as well, we'd love to hear from you in the consultation. Next up, we have another interesting item, really mainly for England, because Scotland and Wales already have decoupled pension fund accounts from administering authorities. So in England, the government are looking at decoupling LGPS pension fund accounts from those of the administering authority. And as we just mentioned, it would align England with Scotland and Wales, who already have decoupled pension fund accounts from administering authorities. So the 26-27 Code ITC is interested in the views of pension funds as to the issues and practicalities they'll face if pension fund accounts are no longer published as part of the administering authority's accounts. So CIPFA would be really interested in views in several key areas, such as accountability statements. So currently, the pension fund accounts form part of the administering authority's accounts and so are governed by the annual governance statement and the statement of responsibilities. So if pension fund accounts are to be completely separated from local authorities' accounts, should the pension fund then be covered by a separate annual governance statement and statement of responsibilities? And we're also interested in views about the approval process for pension fund accounts and whether ultimate approval should remain with the administering authority's audit committee or be placed with another committee or board, such as the local authority pension fund board. Then we've got audit requirements as well. We're interested in views from practitioners and auditors as to the practical implementations and issues that could arise in terms of applying the current local audit regime to pension funds after separation of accounts. So this would include value for money assessments, inspection, and objection rights. So auditors' right to issue public interest reports and statutory recommendations. And then we also have a bit about publication timescale. So one of the benefits of decoupling is to reduce the risk of audit delays on administering authority accounts, impacting the timely audit of pension fund accounts and the ripple effect of these delays on the audits of other admitted bodies. So in the ITC, we present two options for publication timescales to ensure pension fund accounts align with the deadline for local authorities audit statement of accounts. And one of those is where the pension fund accounts are published separately with the annual report to follow, or the other option is to bring forward the deadline for the entire annual report, which includes the pension fund account. So our thinking is probably ideally the pension fund's annual report, including the pension fund accounts, would align with the publication timescales of local authority accounts. However, we'd be interested to hear if there are any barriers that would prevent this from happening. And I think this is probably appropriate time for me to now hand over to Hazel for the second part.
Thanks, Ben. So the second half of the consultation looks at the more routine changes that will impact on the code, starting with accounting standards effective from the 1st of April 2026. So amendments to the classification and measurement of financial instruments. It's heavily focused on IFRS 7 and 9, with some requiring amendments to the code material and others not requiring any changes. As the code refers to the relevant standards without detailed material, I won't run through all these changes. We've included some on the slide, but we don't feel they would have a significant impact on local authorities. However, we welcome your views in the ITC. Perhaps the more significant item is the amendment for contracts referencing nature-dependent electricity. These are targeted amendments to enable better reporting of the financial effects of nature-dependent electricity contracts, which are often structured as power purchase agreements, or PPAs. The fluctuations in volume created difficulties in determining how they should be accounted for, and to better reflect these contracts in the financial statements, the IASB has made targeted amendments to both IFRS 9 and IFRS 7. The amendments include clarifying the application of the own use requirements, permitting hedge accounting if these contracts are used as hedging instruments, and adding new disclosure requirements. Overall, the amendments assist with mitigating volatility that might otherwise have been introduced to the surplus or deficit. By clarifying the own use exemption, the amendments ensure the agreements where an authority is expected to be a net purchaser over the contract period are not accounted for as derivatives measured at fair value through profit or loss. For agreements that do not qualify for the own use exemption, the amendments also provide guidance to support the application of hedge accounting, which can help to offset volatility if it does arise. For example, virtual power purchase agreements, which do not qualify for the own use exemption due to the lack of physical delivery. We understand some authorities have already entered into power purchase agreements, and they have the potential to be more commonplace, so it'd be good to hear thoughts on this in the ITC. Finally, in March 2024, the Financial Reporting Council published amendments to FRS 102, resulting from its periodic review. This included further guidance on how to determine whether an asset meets the definition of a heritage asset and requirements for leases of heritage assets. In the ITC, we're not proposing any changes to the code for the revised material, as the code remains consistent with these requirements. Therefore, the ITC is primarily highlighting these changes and seeking views on the approach of no change to the code. Next slide, please, Ben. There are two new IFRS standards that are effective from the 1st of April 2027, and the consultation is interested in practitioners' early thoughts about the impact of these. IFRS 18 replaces IS 1, although it carries forward many requirements from IS 1 unchanged. However, IFRS 18 does introduce 3 sets of new requirements to improve reporting of financial performance and provide a better basis for analysis and comparison. These are improved comparability in the comprehensive income and expenditure statement, enhanced transparency of what they call management-defined performance measures, and more useful grouping of information in the financial statements. Next is IFRS 19, which permits eligible subsidiaries to use IFRS accounting standards with reduced disclosures. Subsidiaries often end up keeping 2 sets of accounting records because the requirements in some standards differ from those in IFRS accounting standards, for which they are required to report to the parent or local authority. Therefore, this standard permits eligible subsidiaries to use IFRS accounting standards, but with reduced disclosures. Whilst these 2 new standards are likely to substantially alter companies' presentations of their financial statements, it's unlikely that these new IFRSs will have a significant impact on the current requirements of the code. However, CIPFA will review these standards and their alignment with the current code requirements. IPSAS are international public sector accounting standards, and these are public sector specific standards based on IFRS produced by the International Public Sector Accounting Standards Board, or IPSASB. There are 3 standards that will become effective on the 1st of January 26. IPSAS 47 Revenue is a new standard that covers all revenue for public sector bodies, including tax and grant income. It replaces 3 previous standards: IPSAS 9, Revenue from Exchange Transactions, IPSAS 11, Construction Contracts, and IPSAS 23, revenue from non-exchange transactions. The standard takes the definition of a contract from IFRS 15, revenue from contracts, and expands the principle into something called a binding arrangement. This is broader than the definition of a contract in IFRS 15 and contains adaptations to allow for a broader enforceability, i.e. not just through legal means. The concept of compliance obligations in IPSAS 47 is also broader than performance obligations in IFRS 15, to also capture revenues from public sector transactions that do not transfer distinct goods or services to an external party. IPSAS 47 also acknowledges that public sector transactions often involve a third-party beneficiary and have three parties to a transaction. For example, a resource provider, entity receiving consideration and responsible for using or transferring goods and services, and the third-party beneficiary, which can be an entity, individual, household, receiving those goods and services. The accounting treatment set out in IPSAS 47 then follows one of two models based on whether the transfer transaction arises from a binding arrangement. Closely linked to IPSAS 47 is IPSAS 48, transfer expenses. This standard provides accounting treatment for expenses arising from a transaction other than taxes, in which an entity provides goods, services, or assets to another entity without directly receiving any goods, services, or assets in return. For example, issuing a grant. Again, this standard introduces two accounting models based on whether the transaction arises from a binding arrangement as defined in IPSAS 47. So what does this mean for the code? Previously, the code adapted the definition of revenue from IPSAS 9 specifically to exclude the reference to ordinary activities. The code also used IPSAS 23 to provide additional guidance on adaptations to IS 20, accounting for government grants and disclosure of government assistance for the public sector. In effect, the code used IPSAS 9 and IPSAS 23 to adapt IFRS 15 and IS 20. CIPFA LASAC is planning to propose to continue these adaptations in alignment with the FREM, but make it clear within the code that these are adaptations of the underlying accounting standards instead of using additional material from IPSAS 47. The board does not feel there would be any benefit in introducing the concept of a binding arrangement into the code, and it views further material on revenue and transfer expenses as unnecessary. However, CIPFA LASAC would welcome the views of practitioners. The third standard issued is IPSAS 49, retirement benefits. This is the first time a standard has been created for public sector retirement plans and was adapted from IS 26, accounting and reporting by retirement benefit plans. The main differences that IPSAS 49 introduces are a simplified definition for defined benefit plans, expanded the definition of net assets, clarification on the calculation of actual present value, the removal of the option to present retirement benefit obligations in the notes, expanded the requirement to present retirement benefit obligations to defined contribution plans, and added the requirement that a cash flow statement should be prepared using the direct method. CIPFA LASAC have reviewed their initial interpretations and adaptations of IS 26 in light of the introduction of IPSAS 49 and confirmed that IPSAS 49 is largely consistent with the prior code requirements. However, the board proposed not to include the addition of a cash flow statement as it is consistent with FRS 102. Although a cash flow statement could provide useful information, the board felt that additional burden this would place on preparers and auditors would outweigh any benefits. There are another three standards which are effective from the 1st of January 27. Concessionary leases and other arrangements conveying rights over assets introduces amendments to IPSAS 43, 47 and 48. Concessionary leases are leases below market terms. The amendments require lessees to measure the right of use assets at the present value of payments for the lease at market rates, based on the current use of the underlying asset. There is no change for lessors. The amendment also provides guidance on sale and leaseback transactions at below market terms, and introduces right of use assets in kind, which are assets received without consideration. CIPFA will review the standard in more detail to determine if it provides useful additional guidance that could impact on the code. IPSAS 50 is exploration for and evaluation of mineral resources, including the recognition of exploration and evaluation assets. The standard aligns with IFRS 6 and only departures are limited to terminology. Stripping costs in the production phase of a surface mine amends IPSAS 12 inventories. It provides interpretive guidance on accounting for waste removal costs that are incurred in surface mining activities. Neither of these two standards is expected to have any impact on local authorities or the code. Finally, we have what has become a standing section in the consultation for other financial reporting or emerging issues, which includes standards impacting beyond 26-27, which we've already covered. But then there are two key items, which are local government reorganisation in England and sustainability reporting. I'll quickly look at these briefly in turn. Alongside the practicalities, we understand reorganisation is going to have significant financial implications, and these changes necessitate a clear and consistent application of accounting standards to ensure transparency, comparability, and accountability. There is already existing specific material on accounting for local government reorganisation in section 2.5 of the Code, and is accompanied by guidance in the Code guidance notes. Therefore, in the ITC, CIPFA is seeking stakeholders' views on whether there are any areas of accounting for local government reorganisation where additional guidance or improvements to existing guidance would be helpful. CIPFA is of the view that local government sustainability reporting should follow best practice internationally and in the UK public sector. There have been significant national and international developments, although the board feels several areas are not yet well developed. Treasury has implemented the Task Force on Climate-Related Financial Disclosures in the central government context on a phased approach over the past 3 years. Following the conclusion of implementation and changes elsewhere in the sustainability reporting landscape, Treasury launched a thematic review to assess the existing sustainability reporting frameworks and consider whether to update their approach to setting reporting requirements. They concluded that there would be a case for going further than their existing sustainability reporting guidance and will convene further meetings to gain views from representatives across the public sector. IPSASB, the International Public Sector Accounting Standards Board, are developing the world's first climate-related disclosure standard for governments around the world, with support from the World Bank. CIPFA is considering how best to support local authorities in any move to sustainability reporting and would like to better understand the capacity to deliver this in local authorities. The board are not proposing to implement sustainability reporting in 26-27, but is instead seeking stakeholders' views on commencing implementation from 27-28. You've all had the opportunity to submit questions via the Q&A option, and you can upvote any questions you'd particularly like to see answered, as well as continuing to submit questions. We'll stop sharing the slides and I'll hand over back to Conrad to ask us your questions, and we'll also be joined by David Lyford-Tilley, who's the Head of Standards and Technical here at CIPFA.
So thank you, Hazel. Thank you, Ben, for those really comprehensive presentations. I know they were really comprehensive because they have prompted so far precisely no questions, which therefore means that everyone is completely on top of the agenda for 26, 27 and onwards. Can I just, perhaps just to sort of, as a prompt, but perhaps our colleagues might want to just think about whether they want to put a question in the Q&A. Could you just say perhaps a little more about sustainability reporting, which I feel is an important issue for us, and I've been anxious to kind of make sure that the local authority sector doesn't lag too far behind other parts of the public or private sector on that. Could you give perhaps just sort of one or two practical examples of the sorts of things that might be required under sustainability reporting so that delegates can get a flavour for what the implication of implementation might be? And then while you answer that, I can see we have got some questions starting to come into the Q&A. But if I could pose that to you first, please.
Do you want me to have a go at that one? Yeah, thank you, Conrad. So, so the TCF, I'll have to be honest, like sustainability reporting, I'm not well versed in it just yet because we haven't yet implemented it. But my understanding is, so with TCFD reporting, which I believe the government have been implementing the 3 phases. There's things like you're looking at your governance arrangements, your strategy, and then there's also like scenario based analysis. So for example, if there was like a 1 degree increase in climate temperature, what impact would that have on your organization and things like that? So it's a bit of, so it's like how it links to your strategy and how it links to your, I guess, your wider organization aims and what you're doing, how it can impact your business, and obviously your governance arrangements around that, and then also some scenario based analysis, I guess. That's my very basic understanding of it so far, and I'm sure it is more in depth than that, but that's just a little bit of a flavour, I guess.
And of course, we want to get the balance right between making sure that there are properly comparable and indeed auditable reports and results in this area without sort of imposing too much of a burden on the financial statements. I do think as a sector we'd look sort of behind the curve if we were to delay implementation beyond 27, 28, and certainly for those authorities that haven't yet perhaps invested all that they might in making sure they've got an accurate count of their current carbon emissions, which is much more complicated than it sounds, might be well worth getting ahead of the curve there, I should have thought. So in the Q&A then, we've got Elgin Roberts, who really was sort of asking, I think, pretty much the same question that I did. You may want to ask a more specific follow-up, Elgin, but for now I think I'll move on to, this is from Anonymous. Regarding retirement benefits, IPSAS 49, will this affect accounting for teachers' pensions and NHS pensions? Found it difficult to determine the potential implications for the information in the ITC. So Hazel, I think you'd like to have a go at that one, and certainly it's important that the ITC gives people responding to it kind of flavour of what implementation might look like. But Hazel.
The IPSAS 49 is for pension fund reporting, so it's for the set of accounts that pension funds produce. So this will have no impact on teachers' pensions and NHS pensions in local authority accounts. And when we reviewed the IPSAS alongside the code, the only potential big change was introducing a cash flow statement, which the board has felt isn't necessary. So basically, there is no change.
Okay, that's about as clear as could be. Thank you. If I go on then to Daniel Beattie. So it would be interesting to get some views on the connection between the potential removal of the expenditure and funding analysis and also the IFRS 18 emphasis on comparability. Might this mean a return to CIRCOP or similar INE preparation? I don't know who is best to answer that one. Ben or Hazel or David, who would like to have a go at that, please?
I'll jump in as no one else has. We haven't thoroughly reviewed all of IFRS 18, but it is a possibility that one way we could both comply with IFRS 8 and IFRS 18 is if we returned to a CIRCOP approach for the CIES. It's not confirmed. There may be other alternatives, and the Better Reporting Group are looking at statutory overrides and will come up with potential proposals for a new EFA or what that might look like. It might not necessarily be a completely new EFA. It might be slightly amended CIES. We don't know yet. They've got complete blue sky thinking. They can come up with any ideas that might help.
Yeah, just coming in on that, we've spoken about Better Reporting Group in general terms here, but obviously there's more detail out there on our website about the various projects, and in fact, actually goes back to, we were saying on the previous question that the proposals that are in this at the moment don't make any changes to the way that the authority is accounting for pension obligations, but one of the BRG projects is looking at pensions accounting and reporting. So there is a possibility of changing there. And we're also, with this question in the consultation, it is phrased so that we can say, well, what would you think if we removed the EFA without an immediate replacement, or do you think it should only be removed if there were a replacement kind of identified and ready for it, or even if are you comfortable with just removing it and not making any attempt to fill that space with in a direct fashion, which might be more what Daniel's thinking here. So I think we're quite open to this.
And that's a neat segue into John Newton's question, which points out that the EFA is a link in the accounts between the budget that was set and the IFRS compliant outturn report. And so if the proposal is to remove it without replacement, and as David's explained, that's an option but not necessarily a firm proposal at this stage. But if that were the case, would it mean there's a predicted outcome of the review of use of the accounts, future presentation of the accounts, i.e. this whole point about IFRS focus? David, I think that's probably for you, isn't it?
Yeah, so I think what John's sort of identifying here is that there's maybe some overlap between some of these questions that we're asking, and I think that's probably quite fair. There's certainly some of them have some impact on others. So I don't know that the removal of the EFA is definitely saying that there's a particular way that we're going on the IFRS, the way the kind of presentation of the accounts. I don't think I would view those as independent. I think we could take either decision and independently of one another. There is also then this question about users of accounts. So just to note on that, there's a project that BRG already completed on the kind of identifying and surveying who people see as the current users of the accounts. That is currently in publication and should be out to the world relatively soon, so in the next couple of weeks. We are also in conversation about whether we should be doing a bit more work on the back of that and collaboration with MHCLG and government more widely to not just assess who the users of the accounts are, but perhaps to actually develop a statement to say, to put into the code to say, to define who we say that the users of the accounts are, which might not just be one group, that could be several different groups. I think realistically probably would have some regard to the interests of various different users in setting that. But again, I don't think that predisposes any particular outcome for any of these questions.
No, that's really helpful, thank you. And I'm really looking forward to that paper on sort of defining users of the accounts more clearly. And whilst I accept, of course, that there are multiple groups, to the extent possible, if that report is able to kind of suggest some sort of prioritization of that, I do think that kind of helps then in the development of the code and financial reporting. But let's see where we go. I'm certainly looking forward to seeing that when it comes out. Another question from an anonymous attendee, and I'll hand this over to Hazel in a moment. So they point out that they're engaging now with the external valuer for the evaluation requirements for 25-26. So it would be really helpful to have a definitive date, or at least a proposed deadline, when the indexation guidance will be available. Hazel, is there an answer to that one?
There is. We are aiming for the end of October, beginning of November. So it's imminent. We realise that practitioners need this as soon as possible. It's written, it's in draft format. We are just finalising, going through approvals and publication.
So next 6 weeks, sooner if possible. That's really, really helpful. Thank you. Okay. So we have some more time, so I'm going to pause for a moment if anyone wants to add to the Q&A. While you're just thinking whether you do want to do to that. It's always helpful to get feedback on sessions like this. So please do let us know whether you felt this sort of met your needs or not. It's also incredibly important we do get responses to the invitation to comment. Sessions like this, I hope are really helpful, but we can't formally take into account sort of what's been said in a, as a consultation response. So, even if it's only a part of the ITC that you put a view on, just make sure you do send that in to us, because that way, we will make better informed decisions about the development of the code in the future. David, I can see you've got a hand up.
Yes, although put it up, and you've covered on one of the ththings I was going to say, which is just to emphasise again, though, there's no issue at all with being a single issue voter here, or if there's only one of the consultation, of course, is comprehensive, covers a lot of areas. If you've only got one particular area that you think is really important, or one or two that you feel that you're qualified or affected by to comment on, there's absolutely no problem with sending in a response that only covers on some of them.
Yeah.
So particularly some of the horizons scanning and so on, that is that gives you quite an open option to kind of look at things. So you may or may not have opinions on that. There'll be some technical details, that Hazel was covering about future standards and what might be happening. But it's really up to you to decide. The only mandatory questions you have to put is your organisation's details, so that we know who we're getting responses from, and obviously making sure that we're getting one response per organisation. But
so
beyond
it's
that,
like writing your name at the top of an exam paper, isn't it?
Exactly. You do indeed, but then other than that, it's up to you to answer as little or as much as you want, and that means that you really can just send in and I think that's particularly also relevant. I know so many people watching might be out in practice and will have a lot on your plate, and some of this stuff can perhaps seem is esoteric, or perhaps it's not relevant to your particular authority situation, and so you don't think you've got any skin in the game. But if there is something that you want to provide comment on, it doesn't have to be something very significant. Hazel has also just asked me to remind you, you can also submit responses and edit them later. So the platform that we're using allows you to do that. I know that in the nature of these things, we tend to get most responses in the last 24 to 48 hours. Completely understandable. But if you've got something that you're pretty happy with, you don't worry about holding on to it just in case you have a thought about changing something later. We won't, I promise, go ahead and finalise things based on what you've put before the deadline. We might keep an eye on consultations that come in before the deadline, but really the work starts in earnest once it closes.
It's really helpful, David. Thank you. Okay. We have 15 minutes left, but we don't need to use it. I can't see any more questions in the Q&A. So could I just thank our panelists, David, Ben, and Hazel, for those really, really clear presentations. Could I repeat the request? Please do submit a response to the invitation to comment. As has been said, you don't have to answer all of it. Any part will do, but it is hugely valuable to us as a board when we make decisions about code to know that we've got as many consultation responses as possible. With that, I am going to draw this session to a close, there being no more questions. So thank you very much, all of the 100 or so people who've joined it. I do hope it's been helpful. Do submit also any comments you've got on the structure of this session, or how you'd like to see these developed in the future. We're always really glad to receive those. Many, many thanks, everybody, and goodbye.
Thanks, Conrad. Thanks, everybody. Bye.